Good morning and welcome to the BMO Managed Portfolio Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Christine Cantrell, Director, Head of Investment Trust. Good morning to you.
Good morning, everybody, and thanks for joining us. So my name is Christine Cantrell, Head of Investment Trust Sales. So I'm just in charge of the marketing and promotion of our range at BMO Global Asset Management. But in fact, we have recently been acquired by Columbia Threadneedle. So I just wanted to highlight that now we're part of a larger machine. It's actually by AUM, one of the top 10 of UK asset managers. But of course, the time that we're going to spend with you today is mostly hearing from Peter Hewitt, who we have an extensive amount of knowledge to glean from, to be honest, because he's approaching 40 years in the fund management industry. And he's in fact managed this particular trust, the BMO Managed Portfolio Trust, since 2008. So with that, I'll hand over to him, who's going to go through the summary of the portfolio and his outlook, and then we'd be happy to answer your questions afterwards.
Christine, thank you. So I'm going to talk about the Managed Portfolio Trust, a little bit about the history of it, how it's structured, a very unique feature, which I think is to the advantage of shareholders, which is which no other investment trust that I know of has. I'm then going to talk about the portfolio. It's a fund of investment trusts. So what have I been doing? What are the major holdings? What's the outlook, the prospects, and then just kind of bringing things to a conclusion and looking forward to any questions that you may have during the course of my presentation. So, just going on here, starting off, and this was launched I launched this trust in April of 2008. And you can see there it had 40 odd million of assets, and it was a mainly retail shareholders. There was over 2,000 at that time, and since then I'm happy to say it's grown quite strongly. I mean, today the assets are around about 180 million, and we've got loads of shareholders. There's no institutional shareholders. There are very few private wealth shareholders. It's almost all individuals, and there's over 15,000 of them. So that's lots. So there's no big holdings in the trust at all. And over that time, we've certainly grown through performance, but also we've issued in both growth and income shares, and I'll explain about the growth and income in a minute, that very nearly 50 million of new equity over the last 7 years. And back in 2015, a small trust called the KN Trust, which came to the end of its life, we were the chosen rollover vehicle, and encouragingly, quite a lot of people chose to come into the Managed Portfolio Trust as shareholders. So, what is the Managed Portfolio Trust, and what am I seeking to do here? And this is the aim, is to be a long-term savings vehicle for private individuals. We are a conventional investment company in the sense that that's how we're structured, but we do have two quite separate portfolios. One of them is an income portfolio, and the other one is a growth portfolio which seeks capital returns only. And to be honest with you, they are not linked in any way at all, except in one interesting feature, which is a transfer of income between the portfolios. And this is the unique element, and I think it adds some interest for shareholders and hopefully is advantageous to them as well. And I'm going to explain this to you just very briefly, so we can shift forward to a slide that I've got here, this one, which hopefully outlines, and it's a very simple I've tried my best to kind of highlight what I'm seeking to do here. And let's imagine we're at the start of the 1st of January and each portfolio is worth 100. And let's assume over the course of the next 12 months, there are no changes whatsoever to the value of these portfolios. So the income portfolio, when I started the fund in 2008, right through to today, has had a dividend yield of somewhere around about 4. And similarly, the growth portfolio, although we're focusing on capital growth, it has got some income as well. And its yield back in 2008 and all the way through to today has been roughly about 1%. So let's just look at that box headed growth portfolio, and you'll see the value of the investments is 100 and the dividends that will be received over the next 12 months, 1. So roughly a 1% yield. And if you then follow down, you'll see it moves to becoming a -1. And actually what happens with those dividends is they get put on a conveyor belt from the growth portfolio and get moved across to the income portfolio, where you see it becomes a +1. At the same time, exactly the same amount is put on a conveyor belt going the other way, except it's called capital, and that moves from the income portfolio to the growth portfolio. So let's assume that nothing has changed over the course of the year. So you can see the growth portfolio over the course of the year doesn't pay out any dividend to its shareholders, never has, never will. But its NAV, its net asset value, has actually gone up by 1 to 101. So that's a minor advantage for those seeking capital growth, which are in the growth pool. But interestingly, for the income shareholders, you'll see the dividends available to be paid to shareholders have moved from 4 to 5. Similarly, the net asset value has fallen by 1 to 99, but we managed to boost the dividend yield of the income portfolio to 5. And all I can tell you is over the 14 years I've run this, that has proven extremely useful, particularly for the income shareholders, in the sense at times when dividends in the market have been falling or have been cut, this provides an extra cushion, and I've never had to move up the yield spectrum to chase yield in higher risk securities at all. I've been able to focus on equity income investment trusts and other investment trusts too. And the result has been quite a steady increase in dividends over the years. And similarly, there is a small boost to the growth portfolio in the NAV. So there are no adverse tax implications to this. You can see on the furthest right box, a sort of something putting the two growth and income together. That's what happens. That there's actually, it's just trying to bias the returns slightly more towards the income portfolio in income and slightly more in growth towards the growth portfolio. So if we can go back to the slide I was on before, which was, this one. So you can see then we listed in 2008. We've got roughly 40 holdings in each portfolio. I'm going to touch on performance in a minute. Over the longer run, it's been quite strong, less so in the last few months. We've had very low portfolio turnover. The last 3 financial years, 2019, 2020, 2021, portfolio turnovers averaged 8%. I mean, that's very low indeed. So I'm a long-term investor, and we keep pretty tight control of the rating of both the income and growth shares. They're currently about 1 or 2% premiums. They vary between a 1 or 2 discount and a 1 or 2 premium. I keep right on top of that. And actually, we've got quite good liquidity of the shares. Even though it's still a relatively small trust, you can buy and sell with confidence. And of course, at the end of each year in the autumn, just after we have our AGM in September, there is a facility for converting from income to growth or growth to income, which has proven to be become increasingly popular with shareholders, and more are actually undertaking that. So these are some of the key points. I just thought I've got two graphs for you here up till a week or so ago of the sort of long-term rating of the investment trusts, and you can see here how they've basically been trading, particularly since about 2013, at a small premium, but it's round about asset value. You can see a big line there, middle of 2020. I think that was just when we went into the COVID pandemic, and there's quite a sharp move for a day or two, but really most of the time it's been pretty stable. And the same for both growth and income, and I think that's quite encouraging. We had to buy in a lot of shares initially back in 2008-9, but actually as performance started coming through, and moreover the market became confident that there wasn't going to be a double discount in these shares, a discount of the underlying investment trust that we hold, and then a discount on the managed portfolio trust itself. Well, there isn't one there. So we trade pretty steadily round about par or at a slight premium. So here's the performance numbers for you, and these are up to quite recently, really, and you can see it's actually up to the end of March. 5 years, 3 years, 1 year. So looking at the long-term performance, firstly, incredibly, after all this time, nearly 14 years, income and growth are exactly the same. I had to check that more than once, but they are up 168.1. And you can see fairly well ahead of the all-share index over that time. Same over 5 years, same over 3 years. Not so over 1 year. And actually, it's almost all due to the period from just before Christmas through to right now. And we've seen a major change in leadership within the market, not just the all-share, across all equity markets globally. And part of the cause of that has been inflation coming through, interest rates going up, bond yields going up. None of that was evident for the previous decade. Inflation was calm, interest rates, well, hardly at all, 0.1 in the UK. And that was very favourable for what are called growth stocks, the technology sector, the healthcare sector. Highly valued, high growth stocks did extremely well. And the growth portfolio in particular was well exposed to investment companies, which themselves were well exposed to that. But everything changed in December, and you can see where we are now, a cost of living crisis, the Ukraine war, interest rates going up. And that has meant a big change in leadership in the stock market. And in particular, the FTSE 100 has led the market, having been underperforming mid and small caps in the UK really for the previous decade, and driven by the oil companies, mining companies, tobacco companies, telecoms companies, some banks, and that's been the area that's performed quite well. And you can see in the quarter to end March, the all-share index is about flat, but actually the 250 index of mid-caps was down 10 or 12%. You can see the investment companies sector index was down 9. Our growth portfolio, having been ahead of the all-share index in the interim period, which ended for us at the end of November, now is well behind. And even the income portfolio, which has been a bit more resilient, that is also lagging the all-share index. And to be honest with you, most active fund managers in the UK have been lagging the index in the last few months. So here's that's the 5-year numbers, but I think these numbers are more interesting for you. And that is, if you look at each individual year, just run your eyes down the all-share index. We're a May year end. What's happened to the NAV of the growth portfolio and then the NAV of the income portfolio? And a few points to bring out here. the growth portfolio up until 2021 had 9 consecutive years of beating the all-share index. Sadly, we're not going to achieve that in this financial year. And the income portfolio has actually only underperformed the all-share index, I think, in 2 years out of that time, which is in 2014 and I think in 2018. And it's also had a pretty good record. But you can see the 10 months up to the end of March, the growth portfolio is 11 points adrift of the all-share, and even the income portfolio is about 7 behind. And that's because of what I was explaining to you, huge change in leadership in the market and a major sell-off in these growth stocks, the technology stocks, particularly in the US as well. And that has affected all fund managers, but it's affected our growth portfolio as well. So with that as background, I just thought I would actually just spend a second looking specifically at the income portfolio for you. And you can see here the yield on the all-share index. It's just north of 3. I've got the yield on UK government bonds, on gilts. That's actually risen quite sharply. It's now about 1.9%. And you can also see the yield on the managed portfolio trust income shares, which are about 4.7 at the moment, which is a useful level. And I've actually charted for you the dividends from each year that we've been in existence. The first 4 years, we managed to maintain the dividend. It was quite a difficult environment then, the great financial crash, lots of dividend cuts. We managed to hold the dividend, and then we started growing it, and you can see how we've grown things steadily. And now the first 9 months of this year, the dividends are up 11%, and that looks very strong indeed. Actually, the full year is not going to be quite as strong as that, simply because the board took the decision to try and level up the amount of dividends you get each quarter. And so that meant boosting the first 3 quarters, and the fourth quarter dividend payment will appear to be down against the fourth quarter of last year. But overall, and I can't make any forecasts as to what the dividends might be, except to say I'm pretty confident that we'll show that we've grown the dividend in fiscal 2022. So hopefully that gives you some background, and I think that's quite a good record. And we've now become a next generation dividend hero from the AIC, the Association of Investment Companies. And you get that exalted status if you manage to grow your dividend 10 years consecutively. And we've done that. So what I thought I would do for you is just show what's been happening recently in the portfolio. And because we have had some changes which I've enacted because I was concerned really as to what the prospects were, and also had to acknowledge the change within the market that I've tried to explain to you. So what we've got here is the top 10 holdings in the growth portfolio as at the end of the last financial year. And if you just run your eye down them, you may or may not be familiar with some of these names, but you can see Allianz Technology Trust. Look at Scottish Mortgage, which says, although it's in the global sector, it's a technology trust. Tesla, Amazon, all of that. And it has been a fantastic performer. And I have actually got quite a few healthcare, technology trusts, and investment companies investing in growth equities. And my word, they have done well. And that portfolio was an absolutely really good performer in 2019, 2020, and 2021 there, right through to the autumn of 2021. And actually only one UK trust was there, Fidelity Special Values. So that gives you a flavour of what it was. And now I can show you where we are currently. And so there have been quite a few changes. Interestingly, I've actually not bought any new holdings at all. What you've seen there is a lot of these names were lower down the portfolio list, and I've boosted them up through additional purchases. And at the same time, I've top sliced some of the previous winners. So you've now got the top 10. Biggest holding is HG Capital Trust, which is a private equity trust specializing in software companies, unlisted software companies in Europe. And my word, that one's done extremely well. Fidelity Special Values, Law Debenture, 2 UK equity trusts, both with a value bias to their investment approach. And then some other ones there, some more defensive holdings like Ruffer, the Brevin Howard Macro Fund, which I've actually held since it launched in 2008. And that is a macro hedge fund, probably the best performer over the last few months. And my word, it's done well. And you'll see a property vehicles showing up in there, TR Property. And I think the outlook for property is certainly a bit better in the next couple of years. So that's the top 10 in the growth portfolio. Harking back with the income portfolio, you'll see this was the top 10 at the end of May 2021. And again, although you can't get nearly as many growth type vehicles in an income portfolio because a lot of them don't pay dividends, there is some exposure there. I had a couple of biotechnology trusts who pay dividends out of capital. My view is it's great for an income fund to get a level of exposure to some exciting investments in that area. And both BB Healthcare, it's now called Bellevue Healthcare, and HBM Healthcare, that's a Swiss investment company, it's a big one, had done very well for us. But there you see Law Debenture, Invesco, Smaller Companies Fund, Secure Income REIT, which is a specialist property vehicle, and that's done quite well for us. And Mercantile Investment Trust, a huge investor, there's nearly 2 billion of assets focused exclusively on mid-caps in the UK. And now, this is how our top 10 is looking here. So you'll see there are some changes. NB Private Equities performed very well. I had the results out just the other day, up 45% over the last 12 months. That's pretty good for the NAV. But you can see some strong performance from Secure Income there. 3i Infrastructure, which has done well. I've not bought any shares, that's through performance. And the likes of City of London, which is a UK equity income fund, and that's been one of the best performers in the UK, focused very much on FTSE 100 and oil companies, miners, some of the areas that have been performing well of late. Good dividend record as well. It's grown its dividend for well over 50 consecutive years. Similar with Murray International, which is a kind of a global equivalent, and they, through performance, have come through quite strongly. And so, in terms of activity, just to give you a flavour of what my view, what I've been doing here, you'll see this is the growth portfolio, and really this is over the last 6 months where I've actually been quite active in terms of purchases and sales. Sold out of Templeton Emerging Markets completely, but look at the rest of them there. Almost all of these were in the top 10. And it is my intention to hold on to these investment companies for the long term. They're focused on secular growth areas. They're very well run, some great fund managers. But I do have to acknowledge that circumstances have changed, possibly for not just now, but maybe the rest of this year, possibly into next year, because of inflation and interest rates and a major de-rating of a lot of these high growth investments. So to give you an example, Scottish Mortgage, which is the biggest investment trust listed on the London market, is down 32% year to date. That's in not even 4 months. It's up more than 10 times over the past decade, but it's down by a third in the last. So my feeling is I'm not going to have it as my biggest holding or second biggest holding, but I am going to continue holding it for the longer run. And the same could be said of almost all these others. The Allianz Technology Trust, I'm seeing their managers tomorrow in my office in Edinburgh. It's run from San Francisco, and my word, they are good fund managers, great trust, what a performer. But again, it's off about 30% year to date. And the same could be said for some of the other ones. Impacts Environmental Markets, I think it's a fantastic trust, obviously focusing on environmental companies, and that's down over 20%. So I have top sliced, mainly actually Christmas and in January, a lot of these highly rated trusts, and that's what I've been investing into. And if you look at the additions there, you can see Fidelity Special Value is a big holding now, but a series of other UK equity trusts where the managers employ a more value-orientated investment style. I've actually bought 2 new companies, Polar Capital Global Financials Trust. Again, that's banks, insurance companies globally, and they are companies that actually benefit from a rising interest rate environment. And so that's deliberately to explain that and to try and benefit from that type of macro where you've got rising interest rates. And I've bought a new private equity trust, Oakley Capital Investments, which actually has performed quite well since we bought it. So that's what I've been doing in the growth portfolio. In the income portfolio, 1 or 2 sales, not so heavily into technology and biotech. So I've reduced a bit of Bellevue Healthcare, BB Healthcare. I also sold out of Monks, which, to be honest with you, isn't really an income fund. But you may remember a little earlier I showed on the dividend record of the income portfolio. And about 3 years ago, we got a huge special dividend from 3i Infrastructure, which I used to go and buy a growth holding, Monks, run by Baillie Gifford, which doesn't really pay much of a dividend, but we held it for a couple of years. It performed quite strongly. But because of what I've been explaining more recently, I've sold out of that one now. And what have I been buying into? Well, there you go. I mean, again, some UK equity trusts, some property vehicles as well. I bought Supermarket Income REIT, which has a good dividend of very nearly 5%. I've added more to Secure Income REIT. It's got a yield of about 4%. And I think that one in particular has got quite a lot of capital growth upside as well. It's a well-run trust, that. But I bought Temple Bar, which is a large cap value investment style. And if you look at the top 10 holdings there, it's BP, it's Shell, Marks and Spencer's, NatWest Bank, the sorts of companies that have actually been performing quite well and probably will continue to for a while yet. So I've been trying to rebalance the portfolios. And what I want to say is I've not been selling out completely from technology or growth-based investments, particularly in the growth portfolio. Actually, there is still a bias to that, but it is a bias to that, not a huge weighting that way that we had partly through performance over previous years. So that's what I've been doing there. And I just thought I would try and kind of summarize for you what my thoughts and what the strategy I'm going to try and employ for you for the rest of this year and looking into next year. And so my feeling is that actually inflation, it's very high at the moment in the UK. It's even higher in America, 8.5% there. And I think we're probably pretty close to the peak. Somewhere over the summer, this quarter and next quarter, the actual inflation prints will peak out. But I don't think inflation is going to fall back that rapidly, partly due to the effects of what's going on in Ukraine and higher oil prices, energy costs and the likes. But also you are beginning to see a feed through into other areas. And wages are going to be going up as well. So there's no doubt that core inflation may prove to be sticky and might be in the sort of 4-5% range well into next year. So the policy response has been raising interest rates, and particularly in America. And that's quite interesting. America's not really affected nearly so much by the Ukraine war. It's self-sufficient in energy. It's got a very tight labour market, unemployment at 40-year lows, inflation at 40-year highs. So the Federal Reserve has begun a campaign of increasing interest rates to combat inflation. The Bank of England is doing so also, probably not quite as aggressively, but definitely it will be. Whereas the ECB in Europe, more affected by what's going on in Ukraine, I think you probably find they're not going to be raising interest rates much till towards the end of the year. So I think there is a danger of overshoot in America with interest rates. And I don't think there will be a recession next year, but you have to acknowledge the chances of it have increased. And if it does happen, it would be in the US. And inevitably, that means it crosses the Atlantic and impacts the UK and Europe as well. So we just have to acknowledge that looking forward. And there is a risk that bond yields could well move much higher than expected. In the US, the 10-year yield is not far off 3% now, and it might end up quite a bit higher than that. And that has an impact on equity valuations and actually on the prospects for the equity market. Having said that, I think earnings growth from companies will still be pretty good this year, but it's going to slow a bit next year, and we're not quite sure the extent of that slowdown. Quite the magnitude of it is as yet uncertain. And this is at a time when the valuation in most equity markets is still well above average. Now, where I've got the US forward PE 19.7. So what is that? That's the price earnings ratio of the Standard & Poor's Composite Index 12 months out, just taking an average of all market forecasts. So that is well above average in America. It's quite high, and a reflection of how well particularly the technology sector has performed in recent years. For European markets, it's round about 15 times, which is also well above average for Europe. In the case of the UK, we are the only major equity market where the long-term average valuation is below trend. We're currently about 11.5 to 12. Now, part of that is because the UK market has a much greater exposure to oils, banks, mining companies, telecoms, particularly than in America. We haven't got nearly so many growth companies there. So there's something structural about that. But nonetheless, the UK is quite attractively valued. And I have tried to reflect that in increasing investments in UK equity investment companies, which have got what I term a more value investment style. And actually, I quite like if they've got a decent exposure to medium and small companies, albeit that they haven't performed well at all. I mean, the 250 index is down 12% year to date. The FTSE 100 index is up 1%. And that's a change of trend from the previous 10 years. Mid caps and small caps outperformed relentlessly. That's where you found the best profits growth, best companies. But for reasons I've tried to explain, that has actually changed in recent months. And I think will continue for some time, not in the very long term, but certainly for just now. And so I guess what I want to leave you with is just to say I'm definitely maintaining my holdings in Allianz Technology, Worldwide Healthcare, those types of investment companies in the growth portfolio, because that's where you make multiple times your money. And up until just before the sell-off in Christmas, I bought Allianz Technology Trust, excuse me, when we launched in 2008. You then had a huge fall in the financial crash later that year. And I haven't bought any new Allianz Technology shares since then. And it had made 12 times money, 12 times. Polar Cap Technology, 10 times. Scottish Mortgage, 10 times. Biotech Growth, 8 times. That's where you get seriously good returns. And so I'm not wanting to exit these funds at all, but they are lower in terms of the overall portfolio weightings within the growth portfolio, and to some extent in the income portfolio also. So we've moved back towards the UK, and that I think is quite an important strategic move, certainly for the next year or two. And so I'm just going to kind of round off here for you with just a bit of a summary as to what I've been trying to articulate for you. We've got a long-term investment approach. It is very definitely a fund for retail investors who are trying to grow in their ISAs, their SIPs, and that's really where our market is. And the growth portfolio has had strong capital performance over the long term, obviously not so good recently, but its growth characteristics have been very popular for parents and grandparents investing for children and grandchildren. Got lots of junior ISAs, child trust funds in the growth portfolio. The income portfolio has steadily been rising its dividends. It's got some capital growth in it there too, and that has proven much more popular with older investors, people who are either close to retirement or retired, who quite like a 4.5% to 5% dividend yield that is increasing. And I think that has quite a bit of traction in that area. So it's designed as a long-term savings vehicle for private clients and retail investors. And that's it. And your fund manager here that's all I own, is shares in this trust in growth and income in equal quantities. It's the same with the rest of my family. And in fact, my daughter has just sold some of her shares to fund the purchase of a flat. And as far as I'm concerned, that's exactly what it should be used for. So I think I'll probably draw to a close there. I've been going on long enough, and I certainly look forward, if you've got any questions, I'll do my best to try and answer them.
Peter, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated in the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we've received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. Christine, if I could, please could I just ask you to read out those questions, and then we can get those responses, and I'll pick up from you at the end.
Perfect. Thanks very much. And thank you, Peter. That was great summary. So yeah, we do have some questions. I'll start off with one from Matthew. How do you view diversification in this style of fund? Do many of the holdings have cross holdings, and how do you manage that?
Well, that's a good one. I kept to roughly about 40 holdings in each portfolio. I think at the moment, income has got 38 or 30, and growth some at 42 or 43. But underneath that, of course, each investment trust itself has quite a lot of holdings. Some are very focused. I'm thinking of the Aurora Trust, which has got 12 or 15 holdings only, a UK equity trust. So it's can be quite volatile, to other ones which have got, maybe 70, 80, 100 holdings. Bankers Trust is one I'm thinking of in the income portfolio. So there clearly will be some overlap with holdings. So, in UK equity income, you will find, BP and Shell appear in quite a number of these trusts. But you also have to be aware of what is the weighting. It might be quite small in one trust, might be a 7 or 8% position in another trust. I tell you an area I've found where there's a lot of overlap, curiously, is in sort of technology and Asian and emerging market funds, where they tend to have quite big holdings in some of the Chinese internet stocks like Tencent and Alibaba, along with Samsung from South Korea and Taiwan Semiconductors, the biggest semiconductor company in the world. And those four companies make up a huge portion of the emerging market index. And actually, that was one of the reasons I sold Templeton Emerging Markets, because I thought, I want some more diversification. Templeton Emerging Markets had over 40% of its whole portfolio. It's a 2 billion sized trust in four companies. So I'd rather get a much wider exposure there rather than just in four big holdings, which are already in quite a number of the other funds anyway. So I keep an eye on that so we don't have too much in terms of overlap.
Great, that's really helpful. From John, what do you see as the greatest risk to the portfolio?
Well, I think if we were to go into a recession, because typically recessions aren't great for equity markets, particularly kind of the 6 months, 9 months before a recession. And that's when you often see quite a sharp pullback in equity markets and, an uncertain environment. Often, if you're actually in the depths of a recession, that can be quite a good time to invest. Everything seems dark and horrible. But remember, markets do look ahead. They're discounting mechanisms. They look ahead maybe 9, 12, 18 months, and they will see a turn, which perhaps is not obvious to those of us who are living through it at the time. So I think the biggest risk would be if there was a sharp recession later next year in 2024, courtesy of interest rates having been increased far too quickly, that would be a risk.
Mm-hmm. That's great. From Nicholas, and he's very flattering about your skill and insight, and he'd like to count on many more decades of your custodianship of the trust. But just wondering if there is wider support to the management of the fund and any precautionary succession planning in case you feel like moving on one day.
Well, it's that undoubtedly that will happen one day, Nicholas. But I'm going to keep going for a bit yet. I'm part of the multi-asset team at BMO, or soon to be expanded multi-asset team as part of Columbia Threadneedle and BMO. And I hesitate to say quite how many people were in it. I'm going to say something like 16 or 18. So there is plenty of resource there. And I actually use that resource quite a bit, in particular to get guidance from what's happening in a macro context, in terms of, yes, inflation and interest rates, but also markets, equity markets, bond markets. Which ones do we like? Which ones do we not like? I don't want to be launching off investing into the Japanese equity market only to find that the official view from BMO and Columbia Threadneedle is Japan is our least attractive market. So that actually, I find that quite helpful. And that lets me spend a lot of time on the stock selection and meeting the managers. And that's very important. I've been doing quite a lot of meetings, actually, in-person meetings in recent months. So hopefully that gives you a bit of background and a bit of confidence that I'll be around for a while yet.
And there have been a few other questions about the integration with Columbia Threadneedle. So I wonder if there's anything else to add to that, but I think you've covered it quite well in that there's more support, more resource, because I think Simon, for example, just wonders if there's any specific impact on the trust because of the integration with Columbia Threadneedle.
I mean, the answer to that is no, because they actually, Columbia Threadneedle don't have any similar type of vehicle to this. And I mean, they do have fund of fund exposure, but mainly in the open-ended arena. And actually that is, I should have mentioned that earlier, talking about resource. We've got quite a large multi-manager fund of fund resource at BMO. And although it's mainly open-ended companies that they focus on, there is quite a bit of overlap. because you might find a really good fund manager, or they might come across a really good fund manager, and he also manages an investment trust. And so I might well have a look at that and think, having had a tip from one of my colleagues saying, you know, this is a good fund manager, see what you think. His investment trust might be worthy of consideration. And so you do get extra bit of leverage from things like that. But to be honest with you, as far as the merger is concerned, absolutely no problem from my perspective, and I can only hope it will be helpful in the longer run.
Yeah, and I would just add to that in terms of the marketing resource and the distribution team. Sure, that's just a larger capacity now. So yeah, hopefully the trust will benefit from that as well in due course. There's been a few questions now on the fee structure. So just trying to consolidate them. You know, what is the effect of double fees on the NAV performance? And in addition to that, it's just, you know, what are the total fees paid or charged, and how is this dragged on performance essentially?
Right. Well, our fees are the annual management fee for the managed portfolio trust is 0.65% per annum. We have a small performance fee, which I hasten to say will not be earned this year, but it's capped at a total of 1%. So it's a small addition. The overall ongoing charges of both growth and income portfolio is just over 1% per annum. I can't remember exactly. It's between 1 and 1.1%. And it's been gradually coming down a little as we have grown in size. I mean, the growth portfolio is about 100 million. The income portfolio is about 75 to 80 million, just to give you an idea. However, on double charging, obviously I'm investing in investment companies, say Scottish Mortgage, who charge, I think it's 0.3 or something like that. It's the thick end of 20 billion of assets. I mean, it's huge. So its fees are incredibly low. And to be fair to Baillie Gifford, and I've got quite a number of their trusts, their fees are almost all on a tiered basis, and I think very competitive. But let me give you an example of fees where I think sometimes there's a danger of not seeing the wood from the trees. I like private equity trusts. Most private equity trusts, even ones that are pretty average within that sector, will outperform the all-share index and outperform the all-share index quite handsomely. Now, in a sense, I am on your side. I would like to see fees lower. I think fees on private equity trusts are too high. You have their base fee, you have carried interest, you have performance fees, all of that. And yet, despite all of that, they have been some of the best performers long term. I always mention fees when I see the managers. I think it's quite interesting. I've got a shareholding in the Baillie Gifford Private Equity Fund, which is just 0.9%. There's no performance fees, there's no carried interest, no nothing. 0.9% from Baillie Gifford. And that is a lot lower than quite some of their competitors. And yet, if you look at the performance of HG Capital or ICG Enterprise Trust, or in the income portfolio, NB Private Equity Partners, wow, they have been really good. So yes, they should have lower fees. I always ask them about that. I try and put pressure on them. Having said that, I'm not going to not invest in them because they have been really strong performers. So I think you just got to watch about endless. You'll end up with just having a Vanguard type ETF if all you're bothered about is fees. So I think you've also got to look at what the output is. Do they consistently beat the all-share index, the world index, whatever it may be? And in most cases, private equity does that. Just an example for you.
Yeah, no, that's really helpful. Cool. Now looking towards your views and your outlook, Simon has asked, which sectors do you see leading the way over the next 12 months? And he references, you know, technology has served you well in the past. And then another, I think Norman asks, are you looking for a new Scottish mortgage somewhere? And if so, what could that be?
Wow. Well, it'd be great to find a new Scottish mortgage.
Yeah.
It's just not that easy. I do think that, I mean, in terms of sectors, clearly, you know, at the moment, both in the UK, in Europe, and in the United States as well, and globally, we've had this switch to what's called value companies and sectors. And by value, I mean, yes, they're cheaper than the average by whatever metric you choose to value a particular company on, but they tend not to be steady growth companies. You find the profits and earnings coming out of oil companies can be all over the place. They had huge losses a couple of years ago. They're currently in profits, but will that be the, you know, and it's all about the oil price, and the oil price were to fall, and who knows, it might do in a few years' time. Suddenly they all fall into losses again. So it's been these types of companies, mining companies, telecoms companies, which are very low growth, mature businesses, which have been the focus of investor attention just now, and they've performed well. I think they will continue to perform well over the rest of this year. I don't think they're somewhere you want to, if you genuinely were investing today and not coming back to look at your investment for 10 years or even 5 years, I don't think you'd really want to invest in these areas. I think you would want to invest in Allianz Technology Trust or Scottish Mortgage or Edinburgh Worldwide, which Baillie Gifford run, and it's in kind of smaller and mid-cap companies, names that, you know, you've never even heard of, a lot of them in the US, one or two in the UK, and that could be the Scottish mortgage of the future, because there's some really interesting companies there. And so I do think that is where you want to have an exposure and maybe look to increase that in due course. And I'll just say one other thing. I had a visit last week. I visited the manager of Herald Investment Trust, a lady by the name of Katie Potts, who's been running that trust since she launched it in the mid-1990s. It invests in smaller technology companies in the UK, in Europe, the UK, mainly the US, with some in Europe and Asia. And it's obviously performed, it's down 30% this year, having been a great performer for many years. And what I found was interesting was the valuation of her portfolio was coming back to being much more interesting again. And the US segment of it, which I think is about a third, was valued at 45 times earnings a year ago. It's now 24 times earnings. And in fact, the whole trust, if you aggregate all holdings together and work out the PE, is currently on a P of 21. It was on a PE of 31. Of course, I should have sold it then, but I didn't. However, the profits and earnings growth from the underlying company has been very good. Its average valuation over the last decade of Herald has been between about 16 and 18. So my feeling is Herald is not a sell anymore. And actually the next move with that trust is probably to buy it. And it might be later this year or it might be into next year, but you've already had significant value compression. And I think that's interesting. And just briefly, one other area which I'm also becoming quite interested in is healthcare. And I think the healthcare trusts, Worldwide Healthcare, I've got in the growth portfolio, Bellevue Healthcare in the income portfolio. That's looking more interesting. They are actually performing in line with the market over the last couple of months. So they sold off very sharply towards the end of last year. But the big pharmaceutical companies, I think when times get tougher, when growth slows and or maybe recession, pharmaceutical companies are quite interesting and tend to be quite resilient in terms of their profits and earnings. And I am interested in the way these healthcare trusts are beginning to perform in difficult markets at the moment. That could be an area to be investing into also in the next year or two.
That's really interesting. Thank you. And there's just one more question before we wrap up, which you haven't covered that much on. So it was useful for Mark to ask the question about smaller emerging markets. So where he's referring to Saudi and maybe some smaller European countries, rather than say the big ones like China and Brazil. Do you have exposure to that type of area?
Well, the answer is I do, and I, a bit like Mark, I'm slightly skeptical of just invest in emerging markets, because actually a lot of these emerging market trusts, and I told you just sold Templeton emerging markets, have just got a few humongous internet digital companies in China, and I'm sure they're great businesses, and they may come again, but they're incredibly volatile and also have been hit by regulations from the Chinese authorities. So the exposure I have in growth portfolio is through the Mobius Investment Trust, which I supported when it had its IPO about 3 or 4 years ago. And it's just started to perform quite strongly now. It invests in small and mid-cap emerging market companies in a variety of different markets, not necessarily just China or even India, but in some of the smaller markets too. And it's run by a guy called Carlos Hardenberg, outstanding fund manager. I think that's an interesting one. And if you like that area, and I do, that's the way to get exposure through it. It's a bit harder in the income portfolio. I've got one called JP Morgan Global Emerging Markets Income Fund, and that has done reasonably well. It doesn't invest because it's looking for income. Chinese internet companies don't pay dividends, so it's not got anything there. And it's performed reasonably well. So I just would have an eye to what's underneath the bonnet of an emerging markets trust. And I quite liked it in the case of Mobius. I think that's an interesting one.
Great, thank you. Hopefully Alessandro will be able to step in now and wrap things up for us.
Thank you very much for that, Peter, Christine, and I think you've actually addressed all those questions you can from investors. And of course, the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Peter, could I just ask you for a few closing comments?
Well, it's, we had a great pandemic and running things from my front room here. And, because obviously the technology stuff and these trusts did extremely well. To use a cricketing analogy, we had a series of boundaries in 2019, 2020, 2021. We were hitting it through the covers for 4 really quite frequently. Things have changed. Markets I don't think they're looking massively exposed, but it's harder to make money. So you've got to work for your runs, take singles here and there. The ball is doing quite a lot off the seam because the pitch and the light isn't that good. So I think that, an element of caution and defensiveness just now is probably quite sensible, and probably for the rest of this year. And so I'm obviously trying to make money, but at the same time, we don't want to lose much just in case, a recession did appear on the horizon, or who knows what's going to happen in the Ukraine war. Events are quite uncertain. So I think have an element of caution just now would be what I would say.
Peter, thank you very much for that, and thank you for updating investors today. Could I please ask investors not to close the session, as you know, we automatically redirect to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of BMO Managed Portfolio Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.